Drawing money out of your company that you own. How do you do it? You don't just physically just take the money out. We got to think about it that a company is actually a separate legal entity. With the tax office, if you do draw money out of the company and you don't do anything about it, you don't actually treat it as anything, the tax office actually treats that as income to your personal name. That means that you're actually getting double taxed. The company is going to pay tax on this profit, and then it goes into your tax return and it gets taxed as well. So what you need to do is just think of it very carefully and speak to your accountant, which is me, or could be me. Your accountant will basically tell you, all right, there's 3 methods to do it, and these 3 methods are basically paying a salary and wages, drawing it out as a dividend, and then the third way is actually taking up a loan from the company to yourself. So let's start with the first one, paying yourself wages. There's specific ways you have to do it. You've got to treat the company as an employer, and you're going to treat yourself as the employee. You need to pay the net amount of the wages to your personal bank account, but then you have to withhold taxes, then you have to pay superannuation, which is 9.5%, and if you pay yourself $100,000, you could be taxed at very high tax rate. So it might not be the best thing. Maybe you should use a hybrid of all 3. So the second one, which was what I was talking about before, was dividends, paying dividends. It's basically whatever profits that the company has made, we just pay that out as a dividend. We work that out that the company has made around $100,000. We're going to pay $100,000 out of the retained profits of the company. The tax credit that the company has already paid goes to your individual name, and you get to put that into your tax return to get a credit for. The great thing about dividends is that there's no superannuation. So you don't have to pay 9.5% super. It's not a salary and wage, so it doesn't affect payroll tax. So you can get rid of all those red tape if you pay yourself a dividend. Then you got that third and last one, which is very handy and a lot of clients love to use, which is borrowing money out of the company. Essentially, you don't have to deal with any taxes for that moment. You can actually pull money out of the company and then return that money. But the tax office has to be very strict on that because they want to make sure that it isn't income. And so you have to commercialize that loan. And how we commercialize that loan under the ATO standards is that it has to be paid within 7 years. There has to be a minimum repayment. There has to be an interest that the tax office allocates to it. And also there has to be strict repayments that have been actually made by yourself. That way it's actually a loan. So having a commercialized loan actually written down, signed by the company director and yourself, and it actually details down when it's going to be paid, then you can actually pull that money out, and it's great. It's useful as well, so you can actually not pay tax on this money that you've received from the company. So just to recap, there's wages, there's dividends, and there's loans. All 3 of them are great, and I would recommend using all 3. If you use salaries and wages only, you're going to be hit for 45% tax because you'll be pulling a lot of money out. If you use loans only, you're going to have a lot of money that you need to pay back to the company, so it might not be the best move. If you pay dividends out to yourself, there might not be any profits to be paid out of the company. So you got to look at all those different ways of doing it and speak to your accountant, and they'll be able to work out what the best way of pulling money out of your company is.